Hey there, everybody. This is Curtis Hearn, and I want to show you today how to do an annual cash flow summary. There's a lot of talk about budgeting and the right way to do budgeting and the right app to use for that, or what's the right method, and of course all of those things are great and fine, but I'm more of a big picture guy, and I like to have the big picture available first. And I do feel strongly that understanding the big picture of your financial situation is more important sometimes than just diving into the weeds. And so that's why I want to explain how to do an annual cash flow summary here today. Okay, so let's start with income. Okay, income, is income. It's how much money you make. It's pretty simple. If you work a salaried kind of job, or you work for an employer and you get a W-2 at the end of the year, or even if you get a 1099 at the end of the year, this is going to be really easy and straightforward. If you're self-employed, that's going to be a little beyond the scope of what I can do in this short video, but it's really not that different, and you can pretty much easily adapt that to your situation. But I'm going to focus more on the majority of folks, which is W-2 employees, etc. So let's start there. First, let's look at income, and I'm just going to type down. This is just a hypothetical situation. I've got John and Jane Doe. Let's start with Jane Doe, or Jane's. Let's just do Jane's salary here, and I can't type clearly. Jane makes $50,000 a year. That's her gross salary. That's before taxes, before anything else is taken out. Now, when Jane gets a W-2, it looks something like this. I created a little spreadsheet here that's supposed to kind of resemble a W-2. Not perfect, but pretty darn close. Now, you can see this is what a W-2 would look like for Jane. Got her name down here. It's got the employer's name, etc. And I want to teach you how to read this real quick, because you're going to get a lot of information off of this for this cash flow summary. The first is, your gross salary is always in boxes 3 and 5. Why? Because every dime you make is taxable from the Social Security and Medicare standpoint. We'll say John also has a salary, and we'll put him at 40. We'll put him at $40,000 just to make something up. So John would also have a W-2, would look similar to Jane's probably. Now, that's their income for the year. I also want to include any other income that they got, if they did some freelancing, whatever they might have done during the year to get other income. You want to include that here. Now let's talk about savings. So again, this is just trying to capture the big picture. So money came in the front door of your financial house, quote unquote, and then savings went out to your savings accounts in various forms, whether that be retirement accounts or just bank accounts, or savings could also be paying down debt. I'm calling that savings because why? It increases your net worth, right? But let's talk about the 401k. Well, how do you know how much you put in your 401k? Well, that's really easy. If you have the W-2 in front of you, you just look at the previous year and you say, oh, that's in box 12. And it's accompanied with a code in front of it. In the sections of box 12, which is listed here in this general section of the W-2, there'll be a D, which is the code for 401k contributions. So that's $5,000. So you'll just take and put $5,000. Now I put a negative number there because that's the way my spreadsheet is set up, but you could do it the other way as well. But essentially I want to subtract that from my income. So also I paid down debt during the year. Now I'm talking about, let's say you had credit card debt of $20,000 at the beginning of the year, and you chipped away at that and you had $10,000 left. Well, hey, that is a form of savings. So we're going to put that down here as debt reduction. We're also going to put down any increase in cash balances. So let's say that you had a goal to increase your cash let's say you had an emergency fund that you wanted to create or increase, and you started the year with $10,000 and you ended the year with 15. So that would be $5,000 difference between those two. And you can just look at your bank statements at the beginning of the year and at the end of the year. Just, you don't have to dive into all the money up, money down flow of funds in those accounts individually. You can just look at all of them in total at the beginning of the year and the end of the year, and you've got a nice snapshot there. I know that cash may earn interest, but in today's world, it's not enough interest to really worry about, so I wouldn't worry about it. I mean, it's 1%, which if you have, $10,000, that's only $100. It's not going to be enough to affect the numbers drastically, so I wouldn't really worry about it personally. On the debt reduction, you might be wondering, well, I'm paying interest there as well. Yeah, but you're generally paying that monthly out of cash flow, so that's not part of savings. I'm talking about the actual reduction in balances, which is the principal pay down on the debt itself. And that is actually savings because that increases your net worth and also reduces your debt. Your interest payments in the future. Another form of savings might be let's talk about like retirement savings such as IRA contributions or Roth IRA contributions. So I'm going to insert a row here because I want my retirement to be together. So I'm going to say John's Roth IRA contribution. Let's say that John put $2,500 in his Roth IRA, and that was his contribution to retirement for the year. And also, let's say that you just had a general contribution to investment accounts. So this could be a mutual fund. This could be a, just a stock that you buy. So maybe you put money in a brokerage account. It could be all sorts of different things. This is a little bit more difficult. You might have to just review the activity in the account online and log in and then filter, run a search on transactions and filter by contributions and withdrawals or deposits and withdrawals, however they word that in their system. And just look and see what the net contributions for the year into that account. So I'm going to just use a simple example of a robo-advisor like Personal Capital. Let's use that one. And you made a contribution to Personal Capital of $5,000, and that's being managed in one of their portfolios, etc. So you saved $27,500, or Jane and John did this year. That's really, really good. They really did well from a percentage standpoint. And then what I like to do is I like to actually figure out what these percentages are, and so you can see that they save 30% of their gross income. That was before taxes. 30%. That's really, really high and really good. Now, obviously, this is a hypothetical case, but the point is, this is an important thing to track, especially because you can look up here and you can look at your retirement savings. So that's the 401k and the Roth IRA specifically. Personal Capital might be considered retirement as well, depending on what your goals are, etc. So that's, what's that, 8% plus another 5%? So you're looking at 13%. And general rule of thumb on retirement savings is at least 15% of your income should go to retirement, unless you start really early, maybe early 20s, and you save and you invest aggressively and you're comfortable with a lot of risk in your portfolio, at least a lot of volatility, I should say, in your portfolio, then 15% is a good number. Okay, let's circle back to that in a second. Let's finish this out, and we're going to talk about taxes. Okay, hopefully you're still with me. Head over to that W-2 again, and you can find all these numbers. $6,500, $3,100, $725. This is the federal income tax number, the Social Security, and the Medicare, and then your state tax number is right down there. So what's really kind of interesting about this, actually this is not an accurate number because this only shows Jane's taxes. So I'm going to just sort of ballpark estimate. But the interesting thing about this is everybody thinks that they pay, the total tax number is whatever their marginal tax bracket is, and that's not true because taxes are what's the word they use? Progressive. So the more money you make, the higher tax rate each additional dollar is taxed at. Okay, so what can you do with all this information? Well, the first thing you can do, and the most important thing you can do, is figure out what you need to live your lifestyle. This $3,600 is just this net it's $43,000, which is what you spent for the year. Because if we know that $91,000 came in the front door of your financial house, to use that analogy, and $27,000 was saved, whether that be to pay down debt or in cash or in retirement savings, whatever, and $20,000 went to various federal, state, government agencies, then whatever's left over is what you spent. Now, this is a much truer picture than what most people are able to come up with when they budget. I find that people do not have a realistic viewpoint on their budgeting unless they are very diligent with it. And for those out there that are very diligent with it, great. But for the rest of us, I think this is a better place to start. Now, in addition, what else can you do with this? This number here, this $3,635 per month, you can track that on an annual basis, and it will change. But once you've got 2 to 3 years, and unless something drastic in your lifestyle has changed, you've got a pretty good picture of what it takes to live your current lifestyle. And what's more is you can use the 4% rule, which is a rule that tells you, how much money you need to be able to retire. You can use that 4% rule, and based on this monthly number, you can figure out how much money you need to have to retire. So for those that are, really concentrating on the goal of retiring early, maybe you want to retire by age 40, all you have to do is take this number here and multiply it times 25, which is the reverse of the 4% rule, and you've got how much money you need to retire, which is pretty dang exciting. What else can you do with this? Well, I've already talked about how you can look at the retirement savings amounts and see if you're sort of in the on track for that. Obviously, if you want to retire earlier, you're going to need to save more than 10 to 15%. You can take a look at the debt reduction and see if maybe it makes sense to increase that at the expense of other things that you're doing. You can take a look at your taxes and say, well, geez, my effective tax rate is closer to 20%. What can I do to lower that? Well, one of the things you can do is you can increase your 401k contributions. That reduces your taxes at the highest marginal rate that you're in, which can go a long ways to lowering your total taxes. Let's say that you're in a very unique situation. You're already taking advantage of lots of tax deductions. Maybe you want to lower that and you want to put more money into Roth IRAs because you believe that you already have a lot of money in tax deferred accounts, so therefore you're going to pay a lot of taxes in retirement. Well, maybe you want to balance that out and put more money in Roth IRA contributions so that when you retire, you have a source where you can draw funds tax-free. The most important thing, I think, is taking a look at this number here, and figuring out that number times 25, that's how much money you need to retire, and it gives you a goal to work towards. So let's do that real quick. Let's see. 3635 times 25. It's not that number, it's the number above it, the annual number. So you would need $1,090,000 to retire, which seems like a really big number, I know, but with compound interest, you can get there a lot faster than you might think. So I hope you like this video. I hope it's helpful. There's obviously a lot of situations I didn't cover, but for the vast majority of people, this I think is a pretty good start. And